Hey everybody, Tom Gentile. I want to welcome you to today's midday report. I am in uncharted territory today as I am coming to you from my living room, actually. Office internet was down, so we had to race back, and I'm coming to you from the laptop. Again, my apologies. It's going to sound a little echoey, but hey, I've got some good stuff for you. It's just going to be a lot shorter than I had thought about. So let's go ahead and get right to it. I'm going to share with you my screen real quick. And I'm actually looking at the SPY right now. I brought this up because there's an area of resistance we are knocking on right now. If we get above and close above the highs that we are seeing here for the first hour today, then I believe that we're going to be seeing the next possibly week or two where we continue to move higher. All right, just making you well aware of what we see going on here on the screen. So that's the one thing I want to mention to you. The other thing is that, like I said, I've got a fantastic program for you here. And to get there, I'm going to need to come on back and make sure that I am sharing everything with you here. So let's take a look first at what we have going on overall. I've got stocks, bonds, currencies, commodities I want to share with you. I also have, I've got some stuff we did last week. So I'm going to share that with you as well. So let me move over here. And again, my apologies for the weirdness that's happening on the screen. That's what happens when when we're in that kind of period where I'm just now working out of the house. All right. Hey, last week we were discussing Facebook. All right. And we had a nice little short-term pop in that. That did well. And I also believe that we may continue to see Facebook move up over the next couple of weeks. You can find out, I'm not going to get into it in detail, but you can find out all about that at our YouTube channel. That's youtube.com/Tom's Trading Room. All right. Sign up. You can actually sign up, subscribe there, and click the bell, and you'll get all of the videos that we have that happened again throughout the week. We put a couple of videos up a week. This week, we're going to talk about the overall markets for July, and we're also going to cover earnings, because we've got earnings coming out, and I want to talk a little bit about that today. So I've got a full update on market averages I want to share with you. That's SPY, TLT, UUP, USO, GLD, and Bitcoin. We'll talk about Q2 earnings on tap for July, kind of a bigger picture look, and then comparing that with the money calendar for the month of July as well. All right, so let's start with a chart of the S&P or S&P 500 here. This is SPY, all right? Symbol here is SPY. And as you can see here, I've got channels up on the screen. And so you're first seeing well, first of all, let's back up. Pre-coronavirus high, 340 on the S&P. Post-coronavirus low, 220. Rally up, we hit a top up here around, I'm going to call it the 325 area. All right. 325 area. We've been stuck in a trading range since about Memorial Day. Right. We're still in that range. However, we've popped up now, and we are in an area. And I showed this to you earlier, 317 and change on the move you see there. And again, a lot of that's going to have to do with what we see happening this week. But a close above 317.50 is going to be a bullish sign for the market. Next area that we would go to for resistance would be the high, the recovery high that we see here, which is right around 325. All right, so we're caught in a range right now between 325 and then call it about 298, and that's where we've been since Memorial Day, since around Memorial Day. So between the two holidays, we've been between support and resistance. All right, looking out past that, the bond market, and I'm looking at TLT. TLT is the iShares Barclays 20-year Treasury ETF. As you can see here, we had lows of around 140. We had spike up highs around 180, back to 140, back to above 170. And then we started to run into a little bit of a situation I call lower highs and lower lows, where we dipped back down to below 155. But what's been happening now is we're trading around the 164-ish area. And we're now kind of caught in a range where we see some really good support down here around 160. And then the resistance is up here at around 168. So you see where these lines actually cross, right? These are channel consolidations. We've got a channel consolidation resistance in this area. Again, the 168 area. We have channel consolidation support right here around 160. And, in order for a trend to happen with bonds, we've either got to break above 168 or we've got to break below 160. Right now, it looks like we're going to gravitate toward the low end if the market continues to move higher. UUP Power Shares US Double Dollar Index. All right, this is this is cash. I don't trade this. All right, you may wonder why I'm even showing it to you. I don't trade it. I merely look at it in order to trade other instruments like SPY. And right now, the dollar has been settling in. Well, let's back up a moment here. Low was just above 24.5. High was near 29. This was the spike when everything was on sale and everything was going into US dollars. Since then, we consolidated into Memorial Day. We broke out of that consolidation and went from an area of about 26.5 down to below 26. And now we've created this tight little wedge, right? It's my belief, based on the trillions of dollars that are being printed right now, that this index wants to gravitate lower. But what's stopping it right now is that other countries are also printing trillions of their dollars. And the UUP Power Shares Index trades our dollar against foreign currency. So that's why it's caught in a lull right now, right? So our dollar may be getting cheaper, but cheaper compared to what? Not foreign currency so much, right? So then I tend to look at commodities. And this commodity is very interesting because this is USO, the United States Oil Treasury ETF. And USO is really kind of showing, since the reverse stock split back at the end of April, when we were reverse split around 17, this thing has just gone gangbusters. And we're knocking on highs again up here around the high 20s. 28.75 was Friday's close. Again, and I mentioned this last week, I'm going to mention it again because nothing has changed. We really have a $25 to $30 trading range since around Memorial Day. We get above and close above 30. That's bullish for the commodity markets. That's also bullish for the stock market. We get below and close below 25. That's bearish for the commodity markets against the US dollar, against bonds, and bearish for the stock market. Gold, again, one of the areas that I feel is the safest place to put your money. I've been saying this for months now. And you can see why, because GLD's gone from the high 130s post-coronavirus. It kicked up and hit 165 once, twice, 3 times, 4 times, and finally got above, and now 165 has become support, where it was resistance for months. Gold's one of those commodities where if we continue to print US dollars, all right, then gold should benefit from the production and printing of US dollars, because what that does is that just arbitrarily pushes those prices higher. Finally, Bitcoin, BTC. So you can take a look at BTC here, and this is interesting because BTC went from, back in April, was trading around $6,500 and ran up to $10,000 very quickly. We've only seen 10,000 one other time in the last few months. And that was, if you remember, when President Trump walked out of the White House with his staff. And this was just after the protest and the social unrest. And I think what happened was the cryptocurrency markets got a little nervous that he was actually leaving the confines of the White House. And of course, we had a spike up. The very next day, we spiked back down. But what's happened since then? We got it's a currency waves buy signal that ended up happening. All right. Very similar to the signals that we receive with Alpha 9. And that happened yesterday. All right. So I wanted to share that with you. That actually happened on a Sunday, because one thing that we all know, especially us that trade cryptocurrencies and microcurrencies, is those markets never close. They're always open for business. So we can get buy signals and sell signals and entries and exits on weekends, on holidays. And I wanted to share that with all of you, that we did see something that came in around, I want to say it was around the $9,100 area on BTC. All right. So let's talk about our July outlook. So earnings. All right. That's the first thing that we know it's going to happen, because we're going to stop talking about coronavirus. And we're going to stop talking about protests and social unrest, at least on the financial channels, because earnings are going to become a topic. Q2 is going to start this month. It's actually starting this week. It's going to be very quiet this week. You're going to start to hear announcements next week. And then the swelling is going to happen. And that's going to happen on week 3 and week 4 of July. The other thing I wanted to show you quickly is a 10-year history of the month using the money calendar, which we use in tomsoptiontools.com. Right? The money calendar is a reflection of what has happened during this same period, going back a minimum of 10 years. We're going to compare the two, because I found a very interesting correlation that I want to share with all of you with both of these. So let's start with earnings. So I put together the month of July, and I want to show you really what you're seeing here. So let's start with July 6th. July 6th, we have 15 companies reporting earnings, 15 companies reporting comp sales, and there are going to be 17 dividends that are going to be affected today in the stock market. Now, when you take a look at this, Mondays, these are the Mondays in July, the Tuesdays, Wednesdays, Thursday, Friday, what you're going to find is that on Mondays, we have the least amount of earnings that are announced. The swelling usually happens on Tuesdays, Wednesdays, and Thursdays. And of course, Friday mornings, we see a couple of things as well. But take a look and see what's going on this week. 7 companies report earnings tomorrow, 11 on Wednesday, 13 on Thursday, 3 on Friday. This is the first week of July. Now, look what happens in the second week, all right? We start to see, look at Thursday, July 15th, 34 companies report earnings, 57 report on the 16th, 22 on the 17th. Remember I talked about the swelling that happens on week 3 and week 4? So here's the full week of week 3. Take a look at Wednesday, the 22nd, 184 earnings reports on Wednesday, July 22nd. 242 companies report earnings on Thursday, July 23rd. So the swelling really starts the week of July 20th through the 24th. Continues the 27th through the 31st. I wanted to share this with you because I want you to take a look at the next chart that I have for you. All right, the next chart I have for you is a chart of the money calendar. So now the money calendar, if I just quickly give you a definition of this, this is something we've had in our possession for years. We have filed a patent for this piece of technology. It's that valuable to us. It's that valuable. What we do is we take the top stocks and ETFs and we run patterns on them every single day. And so we're looking at millions of bits of data across thousands of securities. We're only taking about the top 300 or so. And those top 300, we're looking for patterns that 9 out of the last 10 years, those patterns have worked. So we need to have historical accuracy of 90 to 100%. This calendar you see right here is an overview. So if you look at today, I've got 92 stocks out of the thousands that are out there that have patterns going back 10 years that represent 90% going up or down. Now, of those 92 stocks, 91 of them today are bullish. They have bullish patterns. Only one stock in the entire mix today is bearish. Now, I want you to look at July 23rd. It's an easy one to spot. 3 weeks down and across, it's the red area, the red, which shows 43 stocks. 6 are bullish and 37 are bearish. Now, the big difference is that I'm able to look at this calendar on an overview and I see the green, which tells me there's more bullish signals than bearish. If it gets yellow, it's almost a split. And when it gets to red, it starts to, obviously orange, a little more bearish. Red is the most bearish of the month. Now, again, backing up. Remember, we talked about the fact that there are fewer companies reporting earnings in the next 2 weeks than in the last 2 weeks. Look at the pattern again. Because we have so few companies reporting earnings, there is less real information to go on, which shows us that the market might drift. We might drift up and down a bit. But once we get more and more of the real companies, the big companies reporting earnings, which really start, they start mid-month, but they really start on the 20th. Then that might be, I've coincided Q2 earnings being soft, all right? I know this by looking at this calendar right here. The last 10 years, we have more patterns to the downside than the upside, and that might coincide with earnings. So let's go ahead and take a look at an example. This is, I took a snapshot of July 6th, and I took another snapshot of July 20th. So July 6th, these are the top 10 stocks that are coming up on the money calendar today. Google, Boeing, Netflix is on here, MasterCard, Apple, BlackRock, Chipotle, United Healthcare, MCO, and you can see those are all green. Now, when you look at the green lines, there's a number at the end of these green bars. For Google, it says 21. That means for the next 21 days, Google has a bullish pattern outlook. All right, we'll look at that again in a moment. But look at the bottom half of the screen here. You see July 20th. July 20th is a complete different mixture of top 10. Top 10 are bearish. BlackRock, Adobe, Netflix, CBS. You've got Royal Caribbean on there. It shows a bull. That's kind of shocking, but that's the last 10 years of history. Lam Research, bear. But you see here, 8 of the top 10 stocks on July 20th are showing bearish patterns. Bullish for the first part of July, bearish for the second. And what I'll do is I'll click on Google. And when I click on Google, I get some more information. And I see, oh, Google, today to August 3rd is a buying opportunity. And I see that the net profits of the last 10 years have been over 500 points for Google. The duration is a 21-day pattern. We know that. We also know the average trades have been over 50 points for the last 10 years. 90% accuracy. The worst that this trade did during its pattern is it went down 23 points. That was what we call the drawdown on the stock. The maximum run up, even though it had an average of 50 points, the max was a 166-point move. That actually happened in 2016 during July. So spotting the opportunity, that's what we do there. From the next thing we'll do is we'll create a low-risk trade. Now, this is an example, by no means a recommendation, all right? But I took some information and I looked at Google and I'm like, all right, if it's going to go up an average of 50 points and we're trading near $1,500 a share, then my target is most likely going to be 1550 on the average. The 1540, for instance, the 1540 calls, if you were to buy those on your own, they're 32 points. You could be right. This pattern could be right. And the fact that these options are so expensive, you could still end up losing money on the trade. So because volatility is so high and because we're going into an earnings season, that also makes volatility even higher, then the best thing to do with these patterns is either you sell premium, all right? Like for instance, sell put options, and you can sell put options. And the problem with put options is you sell them, you might be in it for the long haul because what if the pattern goes down? You could be assigned the stock. The screen you see in front of you here involves what we call a bull call spread or a loophole trade. And that's where we're buying a lower strike call and selling a higher strike call and being able to do that and finance those 1550s with the 1540s we pay for. And now we got to trade for a little more than $400 that has a 143% maximum profit over what you're risking on the trade. In order to get 100% return on Google, it would need to go to $3,000, right? But with this type of an option trade, you're limiting your risk. The contract risk is $410 as of this morning. You're limiting your reward, however. Your reward is going to be $590 based on this spread here, all right? And so you see here, limited, low risk, low cost, limited reward, but the max reward is more than double what the cost of the trade actually is. All right. Here's what the chart looks like if we were to look at a risk chart of this particular screen of Google. So you've got a maximum risk, and that's what you pay for the trade. No matter if Google goes to zero, you're only going to be out what you put into an option trade. In this case, this particular example was $410. Your maximum reward is $590, and that doesn't. If Google's above 1550, it doesn't matter if it's at 1550, 1600, 1700, 3000. You still are capping your reward. All right. You might say, why would I want to do that, Tom? Well, that's because what it does is it reduces the cost of the trade. And break even. The break even, when you buy a stock, your break even is where you paid for the stock. If you buy a call option, your break even is going to be strike price plus premium. Remember the premium on just the calls only. We're talking like $32. So that's $32 above the strike price. But if we take a trade like this, the 1540, 1550 example I showed you, and we add $4 to that, your break even is going to be $4 above the strike you bought. So 1540 plus 4 is 1544. That's your break even. That's where Google has to be at by expiration of the trade. All right. So guys, you see all that blank screen to the right hand, to the right hand side. That's where I was supposed to be, showing you this, drawing, going through and interactively showing you this presentation. And again, my apologies. I got folks on the way to correct the internet problem. It was not a Wi-Fi issue at all. It was actually the hard lines were down too. But if I were to summarize our time together this morning, which is shorter than normal, July has kind of a melt-up feel to it, all right? It's not over yet, according to our patterns. Earnings will start to really take effect in week 3 when the bulk of companies report, and the money counter suggests that the back half of July will also be soft, okay? So keep that in mind as we go throughout the week. Again, what do we do here? Every week, I talk about spotting rules-based opportunities. I talk about creating low-risk, high-probability trading strategies and planning them from start to finish using your broker's website. All right, guys. Hey, thank you very much for joining me on this edition of our midday market report. Again, my apologies for the technical problems, but at least I was able to get through some of this with you and show you what it is that I'm looking at on the screen. Have a great rest of your day. I'll see you again, hopefully face to virtual face next week. We'll talk then. Bye now.